Cashflow Chronicles. This is episode, what is this, number 37 or something like that? Excited that we are on number 37 with Chris Patel,
It's,
the Desi
it's
guy.
the post Vegas recap.
The post Vegas recap. We were just chatting back behind the scenes, and Steven was telling us that we don't know how to gamble, basically. But we're happy to have Steven Fiorillo. Sorry, I had some echo and feedback. That's my fault. To talk about ENBRIDGE. So I know, Steven, you've written a lot about ENBRIDGE. I know you're a dividend kind of guy, and also you've prepared some material for us today. So excited to see what we can kind of get up to with respect to that. I did have some people reach out via X and ask if we wanted to talk on SoFi at all. If we have a little bit of time, I want to focus mostly on ENBRIDGE, of course, because I did have several people reach out with respect to that. But there is also something else that I wanted to share with people, and this is something I hope to build on as we kind of go forward on the channel and on the show, which is this kind of calendar here. And this isn't necessarily to like say when I have something on here that it's guaranteed to happen, but it's something that might be able to help us out a little bit. So obviously on Fridays, we have SoFi Weekly, we have Palantir Weekly. We could put other things on here as well, but I think it's a nice thing that kind of gives us an idea as to what we might be expecting to talk about on the channel a little bit, comparatively to say, instead of just showing up randomly, you kind of have an idea as to what it might look like. So obviously tomorrow we have PayPal coming out. We have the FOMC news coming out. Thursday is a big day. Palantir, Apple, AppCellera, Nintendo, Rocket Lab next week. I'm a big Rocket Lab guy. Somebody in X wanted us to talk about Nintendo. You also have Dutch Bros next week as well, which I need to put in here. You have October CPI coming in the middle of the month here, NVIDIA later in the month. And so this calendar is probably going to be something that gets filled out, but it's something I'm going to trial. So if you guys have any thoughts about what you want to put in there with respect to earnings that are coming up or with respect to any companies, it'll help kind of keep me and Chris grounded as we kind of go forward. And Chris, of course, this isn't something I've talked to you about formally, but feel free to add and steal as you see fit for your own use as well. But Steven, I'm going to let you introduce yourself, and then Chris, obviously been talking for about 3 minutes now. Chime in with anything that you might see, but I'm excited to hear about what you guys have with ENBRIDGE.
I don't need an introduction. Just go into it.
Well, Steven, you're the expert about ENBRIDGE, man. I'm not so much about it. The only MLP that I've invested in the past is Kinder Morgan.
ENBRIDGE is not an MLP.
Oh,
they're a C corp.
First. Okay, so they're like KMI now. Okay, very good.
So how did you guys get on ENBRIDGE? One of the somebody who follows the channel?
Yeah, somebody follows the channel. They reached out to me and said specifically wanted us to follow ENB. What's our thoughts? And I said, I know just the guy, and his name is Steven.
Chris, are you in any midstream operators right now?
I don't have any midstream since it's been quite a bit since I touched any midstreams.
Okay.
Mainly because of the tax treatment. I didn't want to deal with the K1s, So,
So before we get into it, I'm just going to say that ENBRIDGE does not have a K1 like a traditional MLP, but they are a Canadian company. So there is a tax difference that gets withheld and whatnot. So you got to be careful of that. Now, I am a shareholder of ENBRIDGE and I prepared some slides. So I'm also a shareholder or a unit holder in Energy Transfer, Enterprise Private Partners, 10K, Kinder Morgan. And I feel like I'm forgetting another one, but all right. So let me share my screen, and I put together a small presentation for you guys.
So for those people that don't necessarily know, we just had June. Hey, June. Good to see you again. We saw June in Vegas, so it was cool to put a face to the name. Midstream is specifically for folks that are like upstream is what I do, which is help produce the oil and gas and get the crude production, kind of like what Steven is kind of showing on here. These are the guys that are actually drilling for the oil and actually finding the oil, developing the projects. Midstreams are the guys that are literally in between, say, the people that are producing, putting it into sort of storage tanks nearby, and then taking it from those storage tanks nearby and moving it across the country into different refineries and things of the like. So that's where the midstream piece kind of comes in. And as Steven's going to kind of allude to, it's more of like the toll roads, right?
Yeah,
You're going down
that's
I-95.
exactly what it is. Think of it as the veins of the country. I mean, when you invest in a
Can you share my screen real quick, Matt? That may help a little bit. Just demonstrate to people. So, do you see that?
I
Share
do,
screen.
but it needs once. I don't know why it won't let me scroll down. Kick this. Oh, why can't I get yours on here? That's a pain. Kick. Okay, there we go.
Okay. Yeah. So go ahead, Stephen. While you talk, I'll just show people.
Yeah, so I have some of these slides in mind, Chris.
Okay.
Chris is going from the ENBRIDGE Investor Day or the latest quarterly. I can't see it, but it's the veins of the oil industry, oil and gas industry. So basically, when you invest in any of these midstream operators, you are getting paid on them transporting or storing oil and gas or natural gas liquids. And most of the contracts are either fee-based or commodity-based. So, yeah, I think it's important to go through the oil industry real quickly, Chris, and then into these slides, because a lot of people, Matt, do me a favor, go back to my.
If you reshare, yeah, sorry.
Yeah.
This
So
isn't as easy as streaming we heard sometimes.
one of the things that we used to hear in 2020 was that oil and gas was going away, huge push into renewables, and
Going to zero.
Renewables is a very big industry and it's going to see a lot of growth. But United States crude oil production, none of these are my numbers. This is from Trading Economics. We're at the most oil we are producing on a daily basis right now.
In the United States, yes.
In the United States. From crude oil exports, we are at a very high point. We are not a net exporter yet, but we are inching our way back. We were a net exporter in 2019 and 2020, I believe. So from the EIA, this shows the 2022 reference case and how much more energy we're going to need by 2050. And in almost every scenario that they modeled out, the oil and gas industry grows from where it was at the close of 2022. And I think that this is something that's very important for people to really understand, that this is our federal government telling us what their projections are. This is not an opinion, not my opinion. This is in their published annual energy outlook. So I took a lot of numbers from BP's statistical energy analysis because they have some of the most comprehensive information. So that was just a snapshot of it. On a global scale, we have been at a net deficit between production and consumption on an annual basis for the past decade. And that's something that I don't think many people realize. On natural gas, very thin spread that we are in a surplus on production compared to consumption. Now, the countries that produced more than 4,000 barrels per day of oil was 7 countries in 2022. And this is everything. Barrels of oil equivalent. So your shale and everything else, not just crude.
Gas. Yeah, includes gas and NGLs. Yep.
Correct. So countries that produce more than 100 billion cubic meters of natural gas was 8 countries, 9 countries. United States, once again, largest oil and gas producer in the world. So projections out to 2050, back to the EIA, you have petroleum in the middle, petroleum and other liquid production reference case, gradually increasing out to 2050, and in a high scenario, up significantly. And the one on the right is very interesting because we are expected to continue to grow our exporting capability on crude. Liquefied natural gas, same thing. The center one is just straight dry natural gas production, very similar to crude, continues to go up over the next 3 decades. And on the right, we are projected to increase our exporting capacity out to 2050. And this is the veins of the country. And Chris was starting to go through the ENBRIDGE PowerPoint that they put together. So this is just one massive shot. The reason I like ENBRIDGE so much is because they're the only triple threat there is in the sector. They're the only one, the yellow up on the top, they have the 3rd largest gas utility company in North America. And that's before you add the 3 gas utility companies that they just acquired from Dominion, because that hasn't closed yet. All the green circles are renewable. They have a $8 to $9 billion portfolio of wind farms and solar farms. And then the red, if I'm not mistaken, is their crude and liquids pipelines, and then blue is natural gas. This is the only triple threat, and I do not know of a single other midstream operator that has a gas utility, not to mention what could be the largest in North America when the 3 gas utilities from Dominion are added in, and a renewable portfolio this big. I mean, this is the triple threat. So I'll stop there, and we can have a conversation that can go into the actual metrics.
Yeah, I feel like the thing. Sorry, Chris. The thing that
No, you go ahead.
I know that a lot of people are doing is they're kind of trying to specialize in one, right? So like NextEra, they're selling off a lot of their pipeline businesses. It has sold their Florida Gas and Power, not Florida Gas and Power, Florida Gas Company to I think Chesapeake. So you have a lot of these companies that might have 1 or 2 that are either simplifying their business and going down to 1. It seems like this is one that is trying to go forth with all 3. And I was curious if you had an opinion as to why that is. And also, I'm assuming you have slides already with what's going to happen with Dominion, but that has huge implications on LNG export in the future as well, right? Because I think Dominion was somebody that was going to be exporting off the East Coast, if I remember.
Yeah, so that was not part of the deal. That actually, they sold their, I believe it was 7,700 miles of pipe to Berkshire Energy. And part of that was their Cove Point exporting facility on the East Coast. And I believe a portion of that was sold to Berkshire Energy as well.
Okay.
ENBRIDGE has one of the largest export crude facilities, I think in Louisiana on the Gulf Coast. It is their, I forget the name of it. It's on their website. It's massive. But I think that they are looking to diversify into everything because it's going to be a sum of everything to fill the need of the global energy mix for the future. And when it comes to the gas utility, they've been in that business for 150 years. This isn't something that they just developed overnight. This is a company that has put all this together over a century.
Yeah. And I think that's important, not just for this particular company, but as you look into and hear about the renewable side and the transmissions and the infrastructure that needs to be built, right? This is the sort of thing that we're talking about when it comes to what needs to happen. Like you just mentioned, this sort of transmission line and kind of infrastructure that has been here has been developed over the past 150 years. And so when you think about how much renewable is necessary to be able to kind of displace something like this, how much time, energy, capital you're going to have to kind of put into something like this before it actually can fully transition. Well, and the one thing I want to make sure that we cover before I hand it back to you, Stephen, is Chris actually from the LNG side has a really good slide. I'm sure you might have it as well, Stephen, that specifically highlights kind of like that that Texas, Louisiana coastline, specifically for the natural gas pipelines, that highlights a lot of what the LNG terminals will be. So I'm sure we'll get into that as well.
Yeah, I
But
have it
back to
on
you,
a
Stephen.
different one. I
Okay.
have all the FERC stuff somewhere else. But what I was going to say was, when you were talking about displacement, I don't think people fully grasp how much oil and gas touch our lives. I mean, it's the feedstock for almost everything. Anything plastic you're using, a pacemaker, a keyboard, a cell phone, your clothing, it all derives from oil and gas. It's not just filling up a car or the actual energy that's powering the electricity. Like, it is everywhere and everything. And we can continue to transition to solar and wind, but there's still going to be a need for oil and gas, especially manufacturing and everywhere else. So this is and that's why the EIA and everybody else is showing that this isn't a 5 or 10 year thing in oil and gas eradicated. It is going to be relevant for decades and decades to come. So when I look at these companies, there's a lot to choose from. And because MLPs and C Corps report a bit differently, why is that? All right, the top line's 10 million, 8 million, 10 billion, 8 billion, 6 billion. I didn't see that, my bad. So MLPs and C Corps report a little bit differently. Some MLPs, they strictly go by adjusted EBITDA and distributable cash flow. C Corps, some of them report adjusted EBITDA, some don't. Some report distributable cash flow, some report free cash flow. So I just did it on a very even level. So just straight EBITDA, straight cash from operations, straight free cash flow. ENBRIDGE is the second largest generator of EBITDA at just over 8 billion a year on a trailing 12 basis, and just under 8 billion on a trailing 12 annual basis on generating cash from operations. So on a free cash flow standpoint, Energy Transfer is the biggest at just over 6 billion annually, called 6.4. ENBRIDGE is number 2 at like 6.1, 6.2 billion. ENBRIDGE is trading at 10.8x its free cash flow, right in the middle of the pack. So ENBRIDGE has a 17.5% free cash flow yield from what they generate in revenue, and roughly a 27.5% cash from operations yield. So I look at what the yields are on this, because every dollar of revenue that they can increase, you're dropping a quarter of that to cash from ops and 17.5% to free cash flow. And then I always look at debt. So you have ENBRIDGE actually has the largest amount in net debt, and their debt to EBITDA is just over 5.5. Now,
so this is actually one of the more interesting things, because while you guys were talking, that's like the first thing that came to mind. Anytime you have these capital heavy companies where it takes a lot of upfront capital, usually means that there's a lot of debt. Now, normally speaking, a lot of people, they look at a lot of debt and they're all like, "Oh my God, this company got a lot of debt."
Verizon, oh my God, Verizon.
Yeah. But the key to it is looking at the debt stack itself and seeing that, okay, how are their cash flows? So can they manage their debt in an efficient way? So like, let me just share something really quickly, because I'm actually, one of the things I love about companies, especially like this, that have durable cash flows that may have short-term weaknesses here and there, is that you actually do get a chance to get, sorry, I'm just looking for that presentation that I had in my bond page, window, entire screen.
And while Chris is pulling this up,
yeah.
There's the link for ENBRIDGE article that Stephen has written. It's the most recent one, is in the description. So if you guys want to pull that up in the background, go ahead and do that, and make sure to hit the follow button for Stephen on Seeking Alpha.
Let me see.
I appreciate
some reason
that.
it's not letting some reason it's not letting me share my. Oh, here it is. Okay, so let's take a look at this. This is ENBRIDGE's LP's debt. One of the things that they have is they have a lot of corporate debt at fixed rates. Now, believe it or not, they had issued this a while ago, but it seems still pretty attractive. And it's pretty liquid. not super liquid, but it is liquid enough that you can actually get a decent yield from it. So right now, this is a 7.35% coupon, and this is for 2045 with almost no calls in between. So if you get something called with debt, if you have something called call provisions on there, that means that the company can call in that debt anytime they want. Well, not anytime, but there's like a certain date after which they can actually just call the debt back and say, here's your money, we're gonna basically give you your money back, and we don't have to pay you any more interest. Well, this coupon is for 7.35, and the current trading price is about $103 per bond, which if you wanted to buy this right now, it costs you like 1,030
Yeah,
roughly, because everything is
slight
in tens.
premium.
But the key to this is that, especially if this is in a tax sheltered portfolio, if we do get rate cuts next year, and very similar, going back to what historical norms were, I think that this could actually rally higher into like the 130s, 140s next year if interest rates were to get cut significantly. The only thing with when investing in instruments like debt instruments, a lot of it is controlled by the 10-year treasury. So you can see here, when interest rates were really low, the price of that bond was trading close to like 160 with a 3.44% yield, which no one is going to accept these days. But in the past, it was. So with bonds, they can actually inversely be correlated to that. So like right now, the yield that you would be getting if you paid this would be like 7.19. If you look historically on the S&P 500, that's typically what you'll get, between 7 and 10% per year. So I think that this, and a lot of bonds like this, might actually be worth looking at in the future for like when rates start getting cut, because I think what's going to happen is there's going to be a move to start chasing yield. And so maybe some people don't want to be in the equity of side of things, and maybe they're like retired and they, want to just chill. Bro, this is the way to do it. You got these companies trading at multi-decade lows. Interest rates are super low right now. So I think a lot of people are enticed by that short-term 2-year treasury, like, oh, I get a 5.5%, coupon or whatever. But my goal is, hey, I want to collect 7, 8, 9, maybe even 15 years worth of compounding 7.5% growth. And every year that I get that interest payment or biannual interest payment, it's just like taking money and putting it into other things and letting them grow even faster. So
Yeah.
I'm not sure if you have an opinion on that, Stephen, if you've
Yeah,
ever done the bond side
no,
of things.
I definitely do. I mean, you know that I watch the Fed very closely, and CME Group has the Fed Watch tool. If you're still
Mm-hmm.
sharing, you can bring it up.
Yeah.
They're projecting that May to June, unless something has changed, is the highest probability of seeing a Fed pivot, where we start seeing rates come down, and that there's an overwhelming, yeah. So we're not
Zoom in
getting
if you can.
we're not getting a hike tomorrow, unless
Yeah.
something drastically gets screwed up from this. And
Mm-hmm.
December there could be a hike, very slim chance. But yeah, if Chris, if you click on that
Yep.
May,
I know. Sorry, go ahead. May one. You want to
yeah, go back
see?
to the first chart
Yeah.
and go to May. So that's when we really start seeing the probability of starting to get cuts. And then if you look at the December tab before you go to the dot plot,
Is
no,
this
December
our?
24, I'm sorry. So you start getting around a 60% chance that we're going to have a 4 handle instead of a 5 handle in front of rates ending next year. So I agree with Chris with and if you go back to the dot plot, I think it's going to say something like 3.9% going into somewhere in
Yeah.
2025 and 2.9% 2026 ish.
Yeah.
That's going to make bonds or it should make bonds with higher yields go up in value and the yield go down in value. So you could lock in your cost on yield at these levels and generate capital appreciation as you go into a cutting environment. And there's roughly 5 trillion sitting on the sidelines in money market accounts collecting 4.5% per Bank of America. I mean, look, I've done CD ladders. I'm sure other people have. What's going to happen when risk-free rate of return is no longer 5.5%, and your ladders that are on a 3-month, 6-month, 9-month start maturing, you're going to have to make a decision on where you put that capital. And I got news for everybody. When rates are under 5 and start getting into the mid to low 4s, people are not going to be as quick to enter into a CD or a treasury ladder because the market's probably going to be rallying because the cost of capital is less to borrow. You're probably going to enter into a strong bull market. So they're going to want to get back into the market and generate yield. The ENBRIDGE's bonds and other companies' bonds like that are probably a very good idea if you're looking for that.
Yeah. I mean, especially for someone who's like retired or close to retirement, looking for a very safe yield in a company that has expanding cash flows. I mean, they'd have to still be very tax efficient on how they approach the situation. But dude, if you think about it, if you have a mortgage that's like, I don't know, 2.5%, 3%, and you have a company giving you 7%, you might as well just put the money in something like this. And now it's pretty much paying your mortgage and principal, and you're getting to keep yourself pretty good on asset wise.
Right.
I mean, so this is what I would say. If you're interested, if you have a low cost mortgage right now, just put this money on the side, put it into some, decent growers like this, and just relax.
And I think one of the benefits of ENBRIDGE being a C corp is they don't necessarily have to distribute all their cash back because they're not a partnership, and so they have that ability to manage some of the debt more flexibly than maybe some MLPs would, where they'd have to wholesale some of the assets to be able to pay off some of that debt.
So I got 2 more slides. So on the equity side, and this is the Canadian side, but the US side, same theory. 28 years of consecutive growth on the dividend, 10% CAGR. I mean, the dividend is huge. It's over 8% right now. And I don't have the updated data with Dominion yet, so I didn't want to try to build anything out. But their medium-term outlook to 2025, they're expecting EBITDA to CAGR between 4 to 6%, their EPS to CAGR between 4 to 6%, and their distributable cash flow to CAGR at 3%. And your DCF and EPS in the medium-term outlook post-2025 is looking to grow at 5%. So this is a company that does have a model. And look, they have a long-term history of growing EPS and growing distributable cash flow. So that's one of the reasons why I really like ENBRIDGE a lot, because almost 3 decades of dividend growth, clear track record on what they're going to do to move forward. And one of the biggest things let me stop sharing, with these companies is competition. I can't go and raise $1 billion and then try to compete with ENBRIDGE or Energy Transfer EPD. Yes, I could, but it wouldn't be smart. This isn't a SaaS company. This isn't a restaurant chain. You need federal regulation. You need land. You need to go through red tape. You need to go through the Army Corps of Engineers environmental process. There's so much that you need to do to get a pipeline up and running that it makes new competition almost extinct. That's why you see the same players with no new companies coming into the space. This isn't AI where anybody can become a huge AI company if they have the right people on the engineering team. And Matt, you can speak to this better than me, but is anything that I just said untrue?
No, I mean, I just wanted to add in, look at all the turmoil that happened around the Keystone Pipeline, right, when Biden took office, right? And how much, protesting there was, and how much debate there was as he kind of took office, and then eventually vetoed for it to even be put in play. But I think that you're right. I mean, a lot of these things are kind of historic infrastructure that have been here, toll roads that have been there and put in place for decades, if not over a century at this point. And it's kind of like just these historic sort of toll roads that are literally just there collecting capital. It's pretty cool to be able to see.
Yeah, there's a reason why Berkshire Energy bought 77,000 miles of pipe from Dominion instead of building it on their own. This is a company that has the clout, political connections, and the war chest to do whatever they want. it was more beneficial to buy the existing assets than start from ground zero on that. Enbridge moves 30% of the crude oil produced in North America. They transport 20% of the natural gas consumed in the US. They have 80,000 miles or so of pipe. I mean, it is a huge.
Well, here's a question with these companies. Typically, I've seen, and this is maybe something that I have to look into further, Stephen, and maybe you can explain. If you know, maybe you can explain. Otherwise, I'll try to do a deep dive into them. So I'm looking at their EPS, right? And they've had these peaks and valleys in their EPS, like some years. Are those derivative issues, like derivative losses that they take on, like as a challenge? If let's say the oil prices, oil prices, natural gas prices, I'm sure that they have an upstream component too. They don't just rely on fixed contracts. Those derivatives, do they play in any part in their earnings?
Yeah. So the two main contracts are fee-based and commodity-based contracts. So fee-based obviously is a set fee. Commodity-based is based on fluctuations with oil and gas prices. And that's why a lot of people that follow these companies don't necessarily go by EPS. They look at the adjusted EBITDA and the distributable cash flow.
Mm-hmm.
Enbridge doesn't report DCF. They report cash from operations and adjusted cash from operations. But
Yeah.
mainly people look at the cash from operations side, not necessarily EPS, only because of fluctuations in commodity pricing. So, that's why I strictly look at the free cash and distributable cash from operations. Like Enterprise Product Partners reported today, they're down. They generated in the past 3 months 1.7 billion in distributable cash flow, and after their distributions were paid, they retained, I think, $776 million in DCF. Like, that's a company that just grows organically, had 25 years of annual distribution increases. I mean, these companies are cash cows. People are investing in them for the income, not necessarily capital appreciation.
Yeah. Yeah, no, I see it. The thing is, my overarching goal for next year is probably going to find a lot of leveraged companies that have a ton of debt on their balance sheets, but have a tremendous amount of cash flow in order to support that dividend plus those charges. Because what's happening is a lot of them are getting sold off, and people are not realizing that they're just initially looking at the debt, and that's scaring the shit out of them. And they're missing a huge opportunity. So I did a stream with, the Wolf Financial thing, Matt, remember?
Yeah.
So I did a stream on Friday when we were still in Vegas, and I remember I brought up Verizon.
Yeah,
and
somebody freaked out.
Someone had a rebuttal. They were like, "But Chris, they have so much in debt, and I had to actually tweet out you should probably reevaluate that. That's like saying to someone who's got a 30-year mortgage at 2.5%. How are you ever going to afford to live in that house? It's like,
go read my last article, whoever that was. I explained the whole debt profile.
Yeah. So I think a lot of companies that had taken on a lot of debt in order to finance their operations during COVID, and now they're getting back to a place where they're operationally becoming more efficient. And also they're getting back to a point where they're generating more operating income. Now, as they generate more operating income, it gives them opportunity to delever and also increase their dividends, especially if they've had dividends for a long time. They can maintain those dividends, actually grow them steadily. But any additional cash flow can go to lower down their leverage. And I think Verizon is probably one of the most interesting because they even have a plan on top of their current dividend increases to actually start doing share buybacks probably by 2025 because it's based on net debt to EBITDA. So I was looking and I did the math in my head. It was really simple to figure out, wait a second, their PE is trading at 6. At this point, the CFO, CEO are just chomping at the bit to buy back shares, but they're not going to do it too quickly right now, especially considering that they do have a shit ton of debt. So they're going to do as much as they can to delever, but also do a lot to cut CapEx. So I wonder if we're going to see the same thing in these industries where we're going to see future CapEx kind of slow down. And because of that decrease in future CapEx, that means that there's future cash flows that are going to be coming in, which are going to either go into three things: increasing dividends, paying down debt, or buying back shares, or organically investing back in the business, but I don't know if that's really the case for certain companies, but it's a very interesting value proposition to look at for a lot of companies that have like high leverage ratios right now that are cash flow positive, that are actually paying down that debt, you know.
Yeah, so I would think that companies like Verizon or AT&T would have an easier time reducing CapEx since they're at the tail end of their 5G spectrum implementation than a company like ENBRIDGE, because a good amount of their CapEx goes to safety and upgrades and maintaining the pipeline. So while it may not be as capital intensive as a Verizon or AT&T, I think it's more constant where there's not as much fluctuation.
Yeah. There's other like an industry that I'm looking at, believe it or not, cruise lines. The cruise lines, depending on which one you're looking at, they have taken on a significant amount of debt. But if you look at their operating income, it's actually starting to recover pretty nicely. So let me just bring up one. I mean, maybe we'll do a full episode on it, Matt. We can keep going with ENBRIDGE right now. Sorry.
For sure. No, I mean, yeah, whatever works best. But I agree with you. I mean, there were a lot of companies that I think this is something that should not be ignored, right? Just because the ability for ENBRIDGE or Verizon to be able to sustain something like this, not all companies have favored well or will favor well. Chris and I were talking about a company when he brings up Carnival. There was another company that was famous and was kind of almost forced to take on debt by the government to ensure that they survived, which was Boeing. And Boeing is not handling things well right now, and they're not actually generating too much cash, as far as I'm aware. I need to dive deeper into the earnings and stuff of the like, but while Carnival is kind of back on its right move, a lot of these other companies were taking on debt not because they needed to, but more because it was so cheap and it was an opportunity, because they know if I could take it on at 1-2%. You're basically taking on free money because of inflation. If you think about it, they were able to take in a lot of this money. And basically now over the past 2-3 years, when inflation has gone things up to 4, sometimes up to 6%, if you look on an annualized basis, it's like they basically took that money and now based off the interest rates are technically have like a negative yield on that sort of capital that they have in on their books. And if they just have that cash sitting there, they're making 5% on that money that they took in, and they only have to pay 1 or 2%, depending on what kind of companies. Now, not everybody's paying 1 to 2% like Apple is, but just sort of a thought that, some people might have when it comes to some of these debt instruments that people were kind of taking on. But I did want to highlight specifically as well. That's why you saw the yields for companies like Altria Group and Pepsi and Johnson & Johnson get pushed down so much when there was a zero interest rate policies, was because people were searching and scavenging for any sort of yield that they could. And now that you're getting to this place where, you have this risk-free 5.5% on the 10-year or just CDs or what have you at the bank, why invest in something that could be jeopardized, right? When you have this risk-free asset. So I kind of hear what Chris and Steven are kind of saying when you have this reversal in the middle of next year to 2025, where things kind of start getting back to more competitive with respect to some of these equities yielding, say, 4 or 5%. You might see these things skyrocket. Debt, specifically like what Chris was talking about with the ENBRIDGE debt out to 2045. It's at $103 right now. That previously was trading at $160 because the interest rate was basically nothing. So in order for it to make any sense, people are buying it for $160, just because it got pushed down so hard. The yield on it was pushing down so hard that people were paying such a high dollar just to get into some of these debt vehicles. So interesting. Anyway, back to you, Steven. I kind of went off on a tangent there.
So, Chris, I was actually going to say, I got a sleeper for you.
Mm-hmm.
So, you know how bullish I was on SLJ.
Yep.
I got another sleeper, and it's not the one that you dislike and I like. Simon Property Group.
The mall REIT?
Mm-hmm.
Dude, I wrote an article on them, came out this morning. Stock went up fucking 4.5% today because they
I saw the whole
earnings.
I saw the Hoya Capital occupancy rates. I don't know if you saw that. I follow this guy
Yeah,
for a lot of
I
great
know
REIT
him.
data.
So,
Yeah.
so Steven, before you dive into this, the thing that fears me most about SPG, I will say this first and foremost, every SPG, Simon Property Group, entity I've been in has been beautiful, right? The Aria Crystal Shops that were right there, that was a Simon Property Group. The mall that I grew up near, the King of Prussia Mall, that was taken over by Simon Property Group. The Galleria here in Houston, taken over by Simon Property Group. Beautiful things. The thing that scares me is I don't know what every mall that Simon Property Group looks like.
Yeah,
And I've seen malls, Steven, in rural America that are literally empty.
I
And so
got
that's
you.
what fears me. That's what fears me.
They
a little bit.
are the Class A malls. They are not the ones that you're thinking of. So yeah, I saw this, and Simon is freaking killing it. And I think the biggest misconception is e-commerce.
This is a cool chart.
So let me. So Chris, you know that Roosevelt Field Mall is a Simon Property Group, right?
Yeah.
Yeah. So I mean, for Chris and I who lived in New York, Roosevelt Field, Walt Whitman Mall, those are Simon Property Group.
It's
Now,
Nassau County.
County. Roosevelt Field is freaking huge, and it's been built up so much. Now, one of the big fears is Amazon e-commerce. I've been hearing this for God knows how long. So this is the numbers for e-commerce. E-commerce is expected to be 16.4%.
Zoom in on that for me.
Yeah. Of U.S. retail sales in 2023 at 1.17 trillion. By 2026, in 2026 is the first time e-commerce crosses over 20% of total retail sales, and it becomes 1.67 trillion of all sales. Now, Class A malls aren't just malls. You have movie theaters, you have restaurants, you have experiences, social fabric. People want experiences. You guys just went to Vegas, human interaction. E-commerce is always going to be there. It's going to continue to go up, but at some point, it's not going to go up anymore, or it'll just grow as retail grows. Now, I looked at them compared to Realty Income, National Retail Properties, Federal Realty Income Trust, et cetera, et cetera. As of last night when I wrote this, Simon Property Group was trading at the lowest price to funds from operation out of all these companies.
Speaking of which, during the pandemic, this would have been a steal. Right? And I remember looking and I was just like, oh, malls are never coming back, and SPG is going to zero, and I'm an idiot because I would have printed, I think, within the time after the pandemic, it went up 150% or something.
So pre-pandemic, their quarterly dividend was $2.10. They stopped, they cut, and since then, I think it's been 5 or 6 increases, and they're back to $1.90 a quarter. They're just off of where they were pre-pandemic. So you're getting the lowest price to free funds from operations. You're getting the highest dividend yield in the group. And you're getting an FFO coverage ratio of 1.6x when you get Simon Property. So this is something, they have over 95% occupancy rate. They're buying back shares. I have personally gone to 2 of their properties in the past 2 months, 3 months, packed. And I think it's tremendously undervalued and over a 7% dividend yield.
I have 2 questions for you, Steven. So June asked a really good question here. How often do people go to the mall? So folks that are in the chat, maybe I'll put a poll up here so people can ask. But I also have a question for you, Steven, because I know you're a big REIT guy. I saw O in a lot of those charts. Are you a big believer in O? I think I might have asked you this in the past, but I just want to double check. Or are you staying away from O right now? It's in the 40s. A lot of people say anything below 50, you should buy it. So
I mean, look, I'm buying more. I don't think anybody should do what I'm doing because I'm a freaking idiot, but I'm buying more. I'm not worried about realty income long term. I think that this is a buying opportunity for me. And I don't know, there's valid arguments as to why it's gone down. You got certain of their operators, such as Walgreens, that has had trouble. They have some exposure to AMC, which not my favorite company. I mean, there's exposure to companies that are going through difficult times, but there's you're always going to need commercial real estate. Some people like the deal that they did with Chris. What was the freaking casino, the Bellagio that they just
Bellagio,
bought
yeah.
into? Some people like the Spirit deal. Some people don't like the Spirit acquisition. It's one of those. I'm just averaging down. It's something I'm holding for 30 years. I don't care. I don't think it's a great value compared to Simon Property, but I do think it's a long-term value.
So do you think that the near term woes of Walgreens, CVS, that will eventually dissipate, and obviously a lot of the decrease in the share price has been associated with the interest rates going up or the federal fund rates going up? Do you think that obviously when you start seeing cuts middle of next year, that's going to reverse, and also you think eventually there'll be a regime change and maybe some of these companies that are hemorrhaging cash right now due to slippage or theft will eventually turn around?
Think it's going to be a rocky road for some time, but I don't see O going away. And I don't want to be a real estate owner outside of my primary residences. So I'm not looking to buy and rent out to people. I'd rather invest in REITs and have a professional management team do everything and just collect the dividends. So for me, O is one of the REITs that I invest in because I like different REITs.
Yeah. I'm more of an opportunist. So I think right now the REITs are
You're an
significantly, huh? I'm a
You're an
vulture. I don't
assassin.
care.
You're a
I am
vulture.
an assassin. I'm an assassin, vulture, mercenary, whatever you want to call me. But basically, I think the whole sector is undervalued. You just have to be very careful with value traps versus actual value. And if you can figure those out, then yeah, you could see a nice run up in a lot of great companies and pretty much just have to hold them for 5, 10, 15 years and get, I think what it is a lot of times people think investing is super hard. Like you have to find these good companies. And it's like, no, they're all around you. It's just, you may not have heard of them because you don't actually see their logos, like their stock symbols imprinted on like every door that you go into. Right. So as an example, like, I don't know, like we were in the Aria. We don't know who actually owns the property underneath the Aria. Well, that's actually the VC
Oh,
finance
VC,
VC.
man.
Yeah, VC. That's what I'm saying.
VC.
But that's the thing. Like, not a lot of people know that. So if you want to if you're bullish on like casinos, you don't have to buy like the casino property. I mean, itself, you just buy the ground underneath the casino and you got nice 10, 15 years worth of growth baked into your investing strategy. So I think to a certain degree right now, a lot of REITs are very undervalued comparatively when you compare them historically to what dividends typically yield, especially in a low rate environment. So I think, I think if you're looking for a good yield, REITs are a great place to look. And also, just as a short-term trading maneuver, I think as rates get cut, there's going to be a lot of yield chasing. I explained that today to like someone who was on my Patreon. He actually gave me a call. And so he was like, can you explain Verizon to me? Because I'm not understanding why you think flat year over year revenue is a good thing. And I said, well, it's not necessarily that it's flat year over year. It's just that they're in a business that's not going to grow very fast and it's not going to contract very fast. But if you look at on it in terms of cash flow, which makes more sense, you would understand that this company has the potential to generate significant amount of cash flow that can get deployed back into other things. One is the dividend. I said, if you were to go back 2.5 years ago and I said, what if a company gave you 8% return per year guaranteed? Would you buy that company? And he's like, yeah, of course I would buy that. Well, you have an opportunity right now. Verizon, they're not cutting their dividend. They're covering it very well right now. And their yield is really high. So just be quiet, shut up, buy some Verizon and chill, So
Yeah, you think about what an 7 or 8% dividend can compound into when you're reinvesting it every quarter. And this is what I don't understand with some investors. They think, well, if you buy something at 30 and it stays at 30 10 years later, it was a horrible investment. But if you're getting 8% a year that's compounding into that, and you're buying more shares, and you're increasing your cash flow every 3 months, and then buying more shares, and it just compounds, you're going to do pretty well. And instead of having to sell shares off to generate income, you can either do what Chris and I do and write cover calls, or you can just stop reinvesting the dividend and take it as cash.
Yep.
And so I have a question. So when you guys think this thing's going to snap back, I mean, do you think it's going to snap back immediately back to the $45, $50 range? Or do
What are
you
you
think
talking
that,
about? Verizon? Is this
yeah,
Verizon?
the Verizon chart. So we're kind of talking about how it was yielding at about a 4% or so, 4.5%, kind of before these interest rate rises. Once it started getting closer and closer to interest rate, it started to creep down, which is, kind of when I sold the company was kind of in the $50, $55 range. Or maybe it wasn't, obviously. I think it couldn't have been because it didn't get up that high. It was probably in the $45, $50 range. Yeah.
You and Buffett both. I mean, Buffett saw it coming too. Like Buffett saw that higher interest rates were going to plague a lot of companies who had a ton of leverage on their balance sheets with their cash flows, okay, in a good place, but it would negatively impact their earnings. So Verizon is the same thing, with these higher interest rates. Not all of their debt is fixed. They do have a good amount of it as a floating rate. And so that does impact their profitability short term. So maybe that's one of the reasons why he got out. And I'm sure that maybe that's the calculation that you had, Matt, when you got out as well. But for me right now, I just see this as a value opportunity because I'm already baking in rate cuts. Like at this point, all the data that I'm looking at is showing how shelter is coming down. Did you guys see European GDP and not GDP, European CPI come out? I think Germany's already in negative mode right now with their PPI is already negative. China's heading into deflation as we speak. They had a couple of months of deflation already hit them. You're starting to see shelter come down in price. I'm seeing price reductions all over the place. So the largest component of CPI, which is shelter, is those numbers are going to start showing up in deep red territory next year. And it's going to force the Fed to start cutting rates. And I think when the Fed starts cutting rates, you're going to see one of two things happen. You're going to see a rally in a lot of these companies that have high leverage because now it's like, oh yeah, well, maybe the next time they refinance, they don't have to refinance it with by cutting off an arm and a leg. And they're viable businesses that actually do make money. So that like I said, everyone's got to have a long-term macro thesis. That's mine. I also think like a lot of companies whose PEs have been compressed, that spring should also like decompress a little bit. So we'll see what happens there. Yeah.
I do want to transition unless you have another thought that you wanted to add it about specifically to Verizon there, Stephen, but I know that you both...
I just had a thought in general, just more about dividends, but
okay.
Go ahead. I'm just writing a few things out.
Okay. Well, the thing I'm going to transition to is not at all dividend related. So if you want to stumble through that really quick, unless you're bringing up your information in the background.
No, I'll do it right now. So basically, there's a REIT that I've been invested in for about 6 years. And right now, my dividends have generated 66.83% of my initial investment. My cost per share, if you factor in the dividends, has gone down from $29.91 to $18.40 per share. I'm up 80.3% as of when the last time I did this data. And my projected annualized dividend income since my initial investment has increased by 67.58%. And this is a stock that when I initially purchased, my price per share is $29.91, and it is trading for $33.78. So stock hasn't moved a lot, but because of my dividends, I'm
what was
up
the stock?
80%.
What's
Sounds like
stock?
stock
Omega
investor.
Healthcare.
Damn it.
So Omega is
right?
one of the first REITs I purchased. I didn't put a lot of money in because I was new to REITs. But look, it has done very well. I bought, and this is my initial investment. I kept it separate. I have more of it in another account, but they are one of the largest in skilled nursing and long-term care facilities. And you have an influx of baby boomers aging into that population segment. And this is, I believe, one of the best well-run in the space. Triple net leases across the board. I've been in them for a long time. I really like them. Not worried about their debt maturities. They have a well-laddered methodology with it. Dividend hasn't grown in the past couple of years, but still yielding 8.5%. Like they never cut it during the pandemic, and strong company. But once again, that's dividends matter sometimes. You know, some people don't like. Some people will say that dividends are an inefficient way of giving capital back to shareholders. They'd rather see buybacks, et cetera, et cetera. I can understand that argument. I invest in REITs for the income, and this has done pretty well for me.
I know OHI has been one that I researched back in the day. I ended up choosing Stag Industrial and Realty Income and WP Carey, which I've sold out of now. Realty Income and WP Carey, I still hold Stag.
Stag's amazing. I mean, as e-commerce continues to grow, you're going to need more industrial space. Stag is the big player in that.
Very good.
So what do you want to transition to?
I did want to get your thoughts. I know you're not prepared to talk about it, but SoFi did report yesterday. I know that I'm not the SoFi guy. That's normally Tanner. That's Tevis. And I know Amit is a big guy on it as well. But I know that Chris, as well as yourself, have positions. And so I wanted to get your thoughts on it. I also have some small spreads.
Just a connection. I do not have any SoFi at the moment.
Oh, that's right. That's right. It was just Amit that had the spreads. That's right.
Yep, I was the one that sold them at 12, baby. I was smart.
So just curious on your thoughts. I think my initial thoughts, so not putting you directly on the spot. I thought it was really good kind of earnings there. I think they're continuing to move towards profitability. I mean, the thing that bothers me still is that I just know it's going to be a long road with competition going forward. And second thing that bothers me still as well is their applications piece of the usability in the user interface associated with their investing side. I still think needs to get up to speed, especially if you're kind of trying to differentiate yourself from kind of the, hey, these are the old school banks, we're the new kid in town, we're social finance, here we are. You still need to do a little bit more work with respect to making things as simple as, say, Robinhood, like we have on the screen. But that'll be enough of me talking about it. But I'm curious what your guys' thoughts are before we, I guess, close it out for the evening. And then I also want to hear as well, other than PayPal and FOMC, if you have any thoughts about what we should discuss for tomorrow, or just wait for the headlines to come in.
Chris, go ahead.
So I would say with regards to SoFi, they are very well run. They have a former, investment banker running the place, so it's a good place to be. The only thing that I would say a little bit against them is that they are still not operating income. Like, are they operating income positive?
I think they're generating positive EBITDA, adjusted EBITDA, but I don't know if they are making true GAAP profitability because of share-based compensation.
No, they were negative this quarter. They say they'll be positive Q4.
Okay. So if they do hit profitability, if they hit profitability, the value goes up to like $11, $12. So it's actually not a bad target to look at right now. But anything beyond 12, I'd probably end up selling again in the short term. So right now is actually not a bad time to be buying some SoFi. I mean, looking at them.
And is your thought for that, Chris, because it's about to be profitable and you think it'll spike up before then? Or is it because, and I guess my thought process is if it spikes up to 12, you would be a seller again. Is that just because of the long-term competition they're going to face, or?
Yeah, it's a combination of long-term long-term competition, regulatory scrutiny around some of the stuff that they're doing. The one thing that does interest me, and take a look at this, Stephen, and this is probably something that you probably follow as well. I mean, this hasn't been updated yet, but their net interest income has been growing pretty rapidly. Non-interest income is growing, so their net income's been shrinking. The losses have been shrinking considerably. When you compare them to the other financials, so it's hard to determine. Do you compare this against other fintechs, or do you compare this against? Are you going to compare this against the banks?
No, you got to
Because
compare
their
against
business,
the banks.
yeah, their balance sheet. I mean, their business model is more related to the bank side. So if you look at a lot of banks right now, they've been sold off pretty hard. So the question is, unless the valuation of that whole sector starts to recover, I don't know if a lot of people are going to give them like a huge premium. Like they don't have a different, in my opinion, they don't have a fully differentiated product in order to me to give them that additional valuation bump. Like, yes, their growth is good, but it's not like, oh my God, growth. What do you think, Steven?
Yeah, I mean, I'm still there's a lot of stuff coming out. Morgan Stanley just upgraded them today. Big shocker, they've been bearish on them, but this was a very, very solid quarter. And you look at their original 2023 guidance. I mean, I might as well share it. This is a company that keeps beating and raising, beating and raising. And original 2023 guidance was high end 2 billion with annual growth of 25 to 30%, adjusted EBITDA of 260 to 280 at a 14% margin. We're now on the low end looking at 19% adjusted EBITDA margin, 386 million in adjusted EBITDA, and an annual growth rate of 33%. This is a company that I am holding for the next decade or longer unless something changes in my investment thesis. I'm not jumping in and out. I believe in Noto. I believe in what the team is doing. And for me, this is the only bank that can possibly get a tech valuation. And I don't know that everybody's looking at it the same way that I am. I don't really care. What I've put in, it's at risk. It can be lost. But this is a company that owns the entire back end. They're in extremely long RFP processes that could take years to play out. But we could see them power a lot of the competition on their cyberbank platform and processing and generate revenue from that and own a huge slice of the pie on the tech side that the archaic legacy banks are going to have to upgrade. There's new regulatory regulations that have come out. They need to upgrade certain things. And when they're in the boardrooms, if they're not getting the bid for one thing, some of these companies don't know that they do processing through Galileo and then the cyberbank through Technesis. So they may have went in for one thing, but get questioned about the other and get a different business. I mean, there's just so much at play here. And I think when not that when the economy turns, but when the rates decrease, I think you're going to see mortgages originations go through the roof. So if I was showing that they can sell loans, they don't have a problem with that. That was a bullshit bear thesis, and they continuously prove it's a bullshit bear thesis. They just did a deal with BlackRock for selling off loans. I mean, they got a lot of good things going for it. And look, this is a company that has not had an easy road. I mean, their number one revenue driver was cut out from under them without them having a say. They've pivoted in the face of adversity. They've built out every other line of business. That's a management team that I'm investing in because
Steven, what was this giant impairment charge? Because I'm seeing almost a $250 million impairment charge here. What's
I'm waiting for the 10Q to come out. I have no idea.
That is a crazy impairment to take, man. Like, I wonder what it was. No, it can't be loan loss provision or anything like that.
You don't think
Yeah,
so?
that's, I don't know. I mean, it's shocking to see that, because I mean, it's literally on, it's like one quarter of it. I wonder. You
I
know what?
think
I'll
they
have
had
to
a
listen.
one-time charge for something. I think it was in the earnings call. I can't
I'll
remember.
have to listen. I'll have to
Let me see
listen
if I
to it
can find
again.
it.
But that's
I got the
probably why they
transcript.
had
Hold
that drop.
on.
Yeah.
Somebody said it's Technisys. Yeah, they bought.
Yeah, earnings per share
underwriting them.
loss excluding the impact of goodwill impairment. So it was a goodwill impairment of something.
Okay. So
Yeah.
goodwill, by the way, if anyone here wants to know, goodwill is basically a non-cash thing that sits on the balance sheet. So as an example, if you bought something for $1 and then you sold it, or a business for $1 and then you sold that business for $2, what happens is the goodwill for that business is technically $1, because you paid $1 on top of asking, which is that $1 what it is. So apparently Technesis was a goodwill impairment charge. So it's a non-cash. So that's actually a really good thing. The problem is that also means, when was Technesis acquired? Was it under Noto or was it under
Yeah, it
previous
was
management?
Q1 2022, I think. I could be
Wow.
wrong on that.
Wow, that's a big impairment charge to
Or
take,
somewhere
man.
in 2021, somewhere around
Yeah.
there.
Yeah, I see it. Okay. Wonder why
Mhm.
they wrote it off. That's
And don't
interesting.
forget, they didn't spend $1 for it. They diluted shareholders. It's all stock base.
Oh, that's interesting. What was the
They
stock
got
price at the
Technesis
time?
by diluting shareholders. They didn't go into the war chest.
Yeah, but what was the share price at the time? That
Like 11 or 12, something like that.
Okay, so they got a discount compared to today. Okay. I'm sure that there was some value to the Technesis acquisition, but still, that goodwill write-off, why write it off? Like, what's the purpose of it?
And I guess my question to you then, Stephen, is you mentioned that you think that SoFi could be the only bank or one of the few banks that could be trading at a tech valuation. Is that because it's a digital only bank and there's
No,
no brick and
no,
mortar stores, or is it because of just the model that they have?
no. I think they could get a hybrid tech valuation where they are not necessarily trading as a financial institution. They're trading somewhere between a financial institution and a tech company if they end up winning a lot of these RFPs and really growing the cyber bank. And if they are the underlying technology for a bunch of regional banks and even some of the large financial institutions. So they're the only bank that owns the back end the way SoFi does. I've not seen another company. That's why JP Morgan went to Think something to build out theirs. And these other companies are looking at companies like Technesis and Galileo to build their underlying infrastructure. So if we really start seeing that tick in the next couple of years, it could be a company that gets a pretty big valuation for something that's in the finance sector. And you look at Noto's experience, like Chris said, he knows exactly what he needs to do to get that valuation. Don't forget, he's got a ton of RSUs that will expire worthless unless he hits certain metrics. So I wouldn't count them out. But once again, you either believe that this is becoming a top 10 financial institution at some point or it's not. Based on last quarter, it would be a 10x if they did. Whether
Can you
that
zoom in
takes
on that a
5,
little bit
10,
for
or
me,
20
Chris?
years is a
Yeah,
different story.
this is interesting too, to take a look at. Their hold on a second, sorry, I made it too big. Their total
Your GPU?
non-interest income, yeah, their total non-interest income is also, looks like it's declining pretty rapidly. I wonder why that is.
Oh no,
If you
this
look
is the
at it,
3Q. Okay.
yeah, so if you look at it from like March of 22, they used to generate close to 160 million a quarter in fees. That's been cut in half to almost 83. So, like I said, this is where we're once again a deep dive into why their non-interest income is dropping. I mean, their net interest income is going up because they have more depositors, and they have more depositor capital that they can lend out and make money on that spread. But it's just wondering. I don't know. Maybe there's a valid reason for this. This why the non-interest income keeps dropping. You know.
Well, last one. We do have earnings for PayPal tomorrow. I am curious. I know Steven is a big lover of it,
Not,
and I know
not them a big lover. The numbers don't make sense.
in terms of it being so valued so cheaply compared to
Yeah,
how much money they're making, how much they're buying back, etc.
yeah, the numbers don't make sense. I mean, look, that PayPal is not something I'm holding for a long time. That's one of the few companies that I'm investing in because I think it is tremendously undervalued, and I'm going to be out at some point in the near future.
Yeah,
You're
I'm in the same. I'm actually in the same boat as Steven. I'll be honest, I'm a little bit more worried than normal these days, primarily because I'm seeing a lot of moves from JP Morgan with regards to doing certain products. They right now it's only for institutional holders, but basically doing transactions with the blockchain, and eventually they want to come up with something that's more in line with consumers. And so on top of that, you also have Fed Now, and now my bank has Zelle. So I like my wife's bank has Zelle. Like it's Zelle is becoming pretty easy to like transact with and do, the money transfers with. So it could play into a bear case for PayPal, in the future. I still think they have a great e-commerce business. The valuation right now makes no sense today, but long term, I don't know.
Yeah, I mean, look, I was buying, my share price is down to around 58. Started buying at like 64, 63. Last week, when I put my article out going into earnings, PayPal was trading because they're expected to generate $4.95 of EPS in 2023. They were trading at just under an 11 forward PE, and their 2025 forward PE was 8.4. And
Yeah.
they are expected from the end of 2023 to 2025 to grow earnings by 29%. And they are
EPS or
generating
earnings
EPS,
because of buybacks.
just buybacks, growth, whatever it is. That's what the analysts have it as. And when I looked at the free cash flow, just on their trailing 12, which was 3.65, 16 times free cash flow. And they are projected to do 5 billion this year. And this is a company that has bought back 19 billion in share repurchases since 2016. And they were on track to return 5 billion in repurchases this year. They still had 2 billion on the authorization that they are buying back at these prices. So we're probably going to see buybacks of who knows how much this quarter, and then more buybacks next quarter or current quarter that we're in. And this is a company that could take itself private at the current rate of buybacks in 12 years.
Yeah,
Like,
that's
I'm
pretty
not
crazy.
staying in this long term because I don't have the same bullish thesis as I do with SoFi. But from a value standpoint, these numbers don't make any freaking sense.
Yeah. Very good. Well, we will probably talk about it tomorrow just based off the fact that they are doing earnings. So, Steven, if you're bored and you want to come on, just let me know and I'll send you the link. But I think it's a prudent time to probably take a stop there before people's eyes start to glass over. We've been chatting on now for just over an hour, almost going on an hour and 15. So, is there any last thoughts between either of you or any suggestions for other streams either this week or next?
No, I think we should just keep our eye on the Fed decision. I mean, it's pretty much baked in that we're not going to get any rises, but I'd be interested in the commentary by Powell to see
Same.
like how they want to proceed into 2025. I'm sure that he's going to be like data driven everything, which is fine because that's what Powell does, right? Data driven, all sorts of everything. The question is going to be more around what are they seeing? Because if they're looking at the same shit that I'm looking at, they should be cutting right now. Like literally start the cuts now, motherfuckers. Like it's that bad,
Yeah.
But then
Well,
again,
that's what Ackman was saying, right? I mean, that's what a lot of people are starting to say. They said the train is coming and it's going to hit them like a ton of bricks.
So I'm going to say something on that. They have a dual mandate, as everybody knows: maximum employment and price stability. At some point, you cannot thread that needle the way that you want to, and you have to pick a side. And in my opinion, it is better to go from 2% to 3% and live with 3% inflation than continue to hold rates too high or even increase when you have businesses that built their debt maturities in a much different environment where nobody was looking at rates being this high, and you have trillions of dollars coming due in the next 2 years where if they don't have favorable rates, you may have assets going back to banks. And it's not just going to stop at those companies that had to turn assets back over to banks. They're going to have to lay people off. Banks are going to be holding assets that they're underwater in. They're going to sell them for pennies on the dollar and take massive losses. Like, this could be the mother of all recessions that may take the R out of recession and go into something else if the Fed does not actually take a stance in one direction or another. And it may not be good. I mean, I don't see how they can keep raising at this rate. Not to mention, our federal interest on our debt, $730 billion a year. It's almost as big as the military industrial complex budget. Like, they are single-handedly increasing the amount of money that we are adding to the deficit. I mean, you can't keep doing this.
Yeah. That's a good place to stop. I'm curious to see what ends up coming through tomorrow, just like Chris and yourself. I'm really looking forward to what Jerome says and how hawkish or dovish he really kind of shows up as tomorrow. And I think that this is the second to last chance he has prior to starting 2024 to lay a groundwork for what we should expect. And
he's going to be hawkish.
I think that, you know, if that's the case, then tomorrow will probably not look very good. But I think if they start to see a little bit of a back off and, you know, more of a things are looking like they're going in the right direction, you know, back off a little bit from 2.0 means 2.0% in terms of inflation. And they start to say, yeah, we're seeing things head in the right direction. I think you might see a little bit of the collar get loosened up a little bit on the markets tomorrow, and maybe it'll be a short-term bottom, and this will be the pivot point in a perfect time, right? Because November is historically one of the better months of the year in terms of returns, generally speaking. I think it's about a 1.6 or 1.8% on average return for the month of November. And then, of course, we know December is always a Christmas rally, generally speaking, headed into 2024 and an election year nonetheless. So
I'll take the opposite side on that.
Go ahead.
Because I don't think this guy wants to come out dovish. I don't think he wants to cut. I think the last thing he wants is the stock market to run. I think he's looking at the price of housing. Mm-hmm. I think he's looking at a lot of different things, and he's probably sitting there saying, if we act dovish and if we start cutting too soon, the market's going to rally.
You're going to be in a yin-yang game. Pendulum
back and forth. The wealth gap is going to continue to increase, and you're going to have houses that are already out of reach for many Americans get even more expensive. So I don't see him being dovish tomorrow.
Yeah, I agree. I do hope that he does take a shot at the administration and government and Congress in general in becoming too fucking dependent on spending. Like, bro, they're like drunk sailors, man. It's just spend on everything. Like, there's no end to this money. And the thing is, the federal government, by not cutting back fiscally, is also making the problem worse, because now you're actually adding to the inflation problems. Like, I mean, this could have been handled with lower interest rates if the federal government said, look, we need to actually get our fiscal house in order as well and make sure that we're not overhiring, we're not overdoing the stimulus, roll back some of the provisions in the damn IRA, which clearly are making shit worse. So I don't know, fiscal policy wise, these guys are doing a pretty shitty job. And I hope Powell calls them out, says, look, no amount of intervention from us is going to make up for you guys spending like idiots, you know? And at the end of the day, that's what's happening right now. We didn't get to $33 trillion in debt because the Fed lowered and increased interest rates here and there. It happened because the people that we elected in power basically said, hey, there's unlimited money everywhere. Let's go out and just spend that shit without any rhyme reason. you
Yep.
know, and it's not good. It's not good.
Yep. Very good. Yeah, I've seen a lot of people be like, oh, well, this opens up because with the IRA, and now this makes sense because of the IRA, and it's all these little loopholes that are going to be put into the system to enable people to start investing in things that are more specific towards green energies and stuff of the like. That really helps out. But anyway, it's a different topic for a different discussion. I appreciate both of you guys hanging in. Make sure that you follow Chris on Patreon, as well as his Twitter. His links are down below, and as well as Steven. As always, great articles on Seeking Alpha, but his links are also down below. And if you don't mind taking an opportunity, the 47 of you here, an opportunity to become a member, the Money Gang here. And we do this Tuesday through Thursday with the hopes to expand to even more times if we see it possible every single week. Let us know on Twitter or X what other things you would like to hear us talk about. This was a request from folks on X to discuss ENBRIDGE, and that's why we brought on Steven, who's a heavy hitter when it comes to ENBRIDGE. So if you guys have any other topics you want to discuss, be sure to reach out to us, DM us, or if you want to see any other guests, reach out to us, DM us, and we'll be happy to accommodate as we see fit. But both of you, thank you so much, and looking forward to talking to you both in the future. And Chris, I'll see you tomorrow.
See you tomorrow.
Better sit down for a sec, guys.